Okay, Khash Saghafi here, Liberty Home Mortgage. So today's topic, of course, that I'm going to go over is the market about to crash? I always hear this. I got to listen, I've done this for 23 years. I've been through a few different recessions, and anytime the market gets tough, difficult, what right away everybody turns to is, Khash, the foreclosure crisis, the foreclosure coming. Listen to me right now. When I'm doing this video, it's August of 2022. I'm telling you this right now, and I did a video a year ago on this. There is no housing crisis about to occur. All of the people out there, and there's some big names out there that do these videos on, they got all the metrics, how the housing bubble is about to pop. Listen, the news is not going to get your attention if they're going to tell you about all the great things that happen in the world today. And there's a lot of good things happening too. They get your attention with doom and gloom, okay? The facts are the facts. There's no housing crisis coming. Now, I will tell you this. If we get bankrupted by inflation, gas prices, grocery, food shortages, and 55 other things, I can't predict that, okay? I can't predict that. Sorry for that one. Set that to the side. Let me give you some simple statistics. I've got it written down here in my notes, okay? Here's some things. We're going to throw this stuff up on the screen, okay? I'm talking about a real estate crash right now. So I'm going to stay away from a lot of the political side of it. We can get political with this stuff. I'm not going to. We're going to stick with real estate. Let's talk about lending, because lending is what I've lived for 23 years. For the last 15 years, the lending standards are dramatically different. Let me tell you the aspects of mortgage lending, which will be the reason why there's not going to be any foreclosure, housing crisis. There's not a bubble, none of that garbage, okay? And I call it garbage, and that's right, it's garbage, okay? Follow me on this one. Number one, investor lending, dramatically down. Number one, I can't say it's the number one reason. I should say this is just what I'm starting with. So it's not, this is not in any particular order. A huge reason why there's not going to be a bubble, investor lending for the last 15 years is down. Second reason, the debt to income ratio standards and affordability standards have been way, way more restrictive for the last 15 years. The credit standards, the standards of assets and needing money. So it's investor loans, way down. Debt ratio standards, way more restrictive. Credit standards, way tougher. Asset standards, money-wise, way tougher. Those are the four biggest reasons why real estate is so strong. Now, let me give you some more information here, okay? Let me flip to my notes here. Okay, let's start here. From 2000 to 2006, late 1999 to 2006, lending standards became very lax, okay? Lending became extremely, and a lot of people say, Khash, you guys were giving a loan to everybody. I've done loans since 1999. We weren't giving a loan to everybody, but I will tell you, the standards were super, super loose. The Cleveland Federal Reserve did a couple studies. Some of them came out in 2009, some came out in 2011. These are pretty important, okay? In 2009, for example, one of the studies that the Cleveland Federal Reserve did was on mortgage foreclosures and defaults. And they found that from the time a loan was given until the time that it showed itself on the market into a foreclosure, generally was around like 4 years, give or take a little bit of time, okay? 4 years. So think about this. What this means is that, and this is another thing we could put up on the screen just to give you a visual of this, okay? The loans we gave in 2002, I wouldn't know if that was a good loan or not until 2006. The loan I gave in 2003, I wouldn't know it until 2007. The loan I gave in 2004, I wouldn't know it until 2008. The loan in 2005, I wouldn't know it until 2009. The loan I gave in 2006, I wouldn't know it until 2010. Now think about that. The lending I did from 2002 to 2006 would not show itself until 2006 to 2010. Go look at all of the statistics and all of the data you want. When did the crisis begin? Quite honestly, late 05, early 06. When did it hit its peak? 2008, 9, 10. The Great Recession was 2007 into 2008. And then, of course, the effects were felt for a long time after that. But let's go to 2010, just as an example. Let me just use the state of Ohio, okay? This nationwide data is easy to get. I'm just gonna give you a unique one, Ohio, just because I live here and this is the data I've researched and I've looked at, not even lately. This is going back 15 years. I've done this job for 23 years. I've done talks like this for 18 years now, okay? In 2010, in the state of Ohio, just the state of Ohio, this is just a snapshot of the United States. In 2010, there were 99,000 foreclosure filings. 99,000. Right now in 2022, in the state of Ohio, there are approximately 10,000 foreclosure filings. 99,000 to 10,000. Don't tell me that we're in a housing crisis, there's a bubble or anything like that. It is not even close. By the way, let me go back to the 4-year mark that the Cleveland Fed gave, okay? The lending we did in 2007 would show itself in 2011. Let's fast forward. The lending I did in 2015 shows itself in 2019. The lending in 2019, 2020, you know what the thing about COVID was? Lending guidelines during COVID became super restrictive. I mean, super restrictive. You're talking the average credit score we've been loaning to is in the mid to high 6s or the 7s. You go back to the subprime days, dramatically lower credit scores. There was a study done by, I want to say it was Equifax in 2009. This is another thing we'll put up on the screen here, is that the level of the rate of delinquency for people who had a credit score over 800. So if you were at 800 plus, 1 out of every 3,000 people would go delinquent on a loan. From 700 plus, 1 out of every 1,500 people would go delinquent on a loan. Under a 620 credit score, 1 out of every 15 people would go delinquent. Let me give you a couple loans that were available back then that we used to do. We had a loan. If you had a 580 credit score or higher, 580, you can go no money down, 1 day out of a bankruptcy, while you were in foreclosure, didn't matter, 580 credit score. Fannie Mae used to have a product called the Fannie Mae Flex 100. I did a Flex 100, that's 100% financing, one time with someone who had a credit score of 470. 470 credit score, Flex 100, no money down. Now people say, Hash, you shouldn't have done the loan. Sorry to tell you this, okay? Hate to tell you this. But at that time, that was the lending that was available. That was the lending that was available. Of course, everyone's a genius and an armchair quarterback looking back on it, of course. But during that time, had I said to the person, the loan's available, but we're just not going to give it to you, you then have something called fair lending violations and discriminatory practices. So that's a whole different conversation we can have at a later time. And I'm more than happy to take that on with anybody out there, okay? Let's go to subprime lending back then. So once again, 2009 data from the Credit Bureau. 1 out of every 3,000 goes delinquent 800 plus. Under 620 is 1 out of 15 people. Since January 1st of 2007, and this is a key date, January 1st of 07 is a huge, huge date in the housing industry. This is the reason why. All the lending standards changed. Subprime lending basically was eliminated as of January 1st of 2007. So think about this. Since January 1st of 2007, if you did not have a credit score realistically in the mid to high 600s, you were not getting touched with a 10-foot stick. And today in 2022, realistically, now again, there's gonna be loan officers out there. I go down to a 500, I go down to this. That's great. You don't do that for your whole book of business. It's not even remotely close. Today, and for the last 15 years, if you're not in the mid to high 600s, you ain't getting a loan. If you're not coming up with even a little bit of money, debt to income ratio and affordability. If you're self-employed and you're watching this video, for the last 15 years, self-employed people have basically been pushed out of the mortgage lending of qualifying for a mortgage loan, because the fact is self-employed is ultimately very high risk. And if you're not showing the income to qualify, you're not getting the loan. This is 15 years of this type of lending. I've lived it for 23 years. I'm just not watching videos and downloading data, and I've done this job for 3 years, and I'm telling you about stuff that I've read in the books of history. This is stuff that I've lived through. The lending for not just today, the lending for the last 15 years is dramatically different. I have some more data from the Cleveland Federal Reserve. Let's go back to 2005, 6, 7, okay? From the Cleveland Federal Reserve, subprime variable rate loans defaulted at a rate of 12%. So 12 out of every 100 variable rate subprime loans resulted in a foreclosure. 30-year fixed interest rate loans that were considered prime loans, which we can give those today in the high 6s or 7s or above, okay? Those defaulted at a rate of 1 out of every 100. Now let me scale that up, and this is something we're gonna throw up on the screen too, is on the subprime loans, let's run it up the scale. Out of 1 million homes, 1 million home loans, 120,000 of them would have gone into foreclosure. Subprime variable rate, 120,000 out of for every million, okay? On prime 30-year fixed rates, it would have been 10,000 out of every 1 million. So think about that. For every 1 million 30-year fixed rate prime loans I give, 10,000 go into default. For every 1 million subprime variable loans I give, 120,000 go into default. Look at the difference. And do you want to know something? Since January 1st of 2007, do you know predominantly the only loans that have been given out? 30-year fixed prime loans. So think about this. For the last 15 years, here's what I want you to do when you're watching me. I want you to go on a strict diet. I mean a strict diet for the next 15 years of your life. This is not, the reason we don't have a foreclosure crisis coming and there's no housing bubble, the reason is because we've loaned like this for 15 years. This is not, we're correcting the mistakes of the past this week. It's been like this for 15 years. There's been essentially no changes for 15 years. And if you're sitting here watching me and you've got bankruptcies, foreclosures, collections, judgments, bad credit, you're sitting here saying, yeah, the guy's right. I've had a super hard time getting a loan. I'm just telling you that this is why it's such a strong market. Let me go to investor lending. In 2010, more than 50% of the foreclosures in the country were investor loans. Investor speculation. Now, we've had a lot of speculation over the last 2 years here in the United States as far as housing goes with buy a house for 200 grand and sell it a week later for 250 because people were going 50 over list price and all this stuff. This was a very small window of time. We're now moving into a much more normal market. It's normalizing where, God forbid, a house is going to sit on the market now for maybe a week or two, right? No one's going to come along and give you $100,000 more than asking with no inspections and no contingencies. Back then, though, investor speculation was so high, it was too easy for investors to get loans. It's just that simple. And if you want to be an investor in real estate, I got news for you. That is a job by itself. That is a profession all by itself. Investor lending since January of 2007 for the last 15 years. If you want to buy an investment property, you got to pony up at least realistically 20% down. Back before 2007, I could do no documentation, no money down, multiple investor loans for people. We're giving too many people loans who didn't know how to handle those types of transactions. You get rid of the investors. And if you're an investor getting angry with me, too damn bad for you, okay? Get rid of the investors, tighten up the credit standards, tighten up the affordability standards, tighten up the money standards. And you know what you have? You have a super strong real estate market. There's no bubble. There's no foreclosure crisis coming. This is the data we have. I'm just telling you this stuff. This is all extremely important. If I were to tell you, and this by itself is a clip and a snippet by itself. If I were to tell you that banks are loaning money to anybody, investor speculation is high, and anyone out there can get a loan, what time period am I talking about? Most people would say, Hesh, you're talking about the mid-2000s with the subprime crisis. I would say, no, I'm talking about the 1920s. Those were the same standards that ran us up into the Great Depression. Those were the same standards that ran us up into the subprime lending crisis and the foreclosure crisis. Those are the standards that I believe we need to stay away from. Unfortunately, there's going to be a lot of good people who don't get loans, but if it results in an overall solid housing market, that's what I'm for. I'm telling you this right now as of this video, August of 2022. There's no housing crisis coming. There's no foreclosure crisis coming. We're on solid ground. This is a great time to buy a home. This is a great time to sell a home because of all the factors I've given. And that's the outlook coming up soon or even in the near or far future.